Ronald Reed was a janitor and gas station attendant. He died at 92 with $8 million. Richard Fosconi was a Harvard MBA, Merrill Lynch executive. He went bankrupt. Same era, same country. Totally opposite outcomes. Why? Because wealth isn't about what you know. It's about how you behave. This is the psychology of money. Let's dive in. Intro. Welcome. Today's book, The Psychology of Money, by Morgan Housel. This book has sold over 4 million copies and changed how people think about money, investing, and wealth. Main idea: doing well with money has little to do with intelligence and everything to do with behavior. Let me break down the 20 key lessons in the next 9 minutes. Lesson 1. No one's crazy. Lesson 1. No one's crazy. Your personal experiences with money make up maybe 1% of what's happened in the world, but maybe 80% of how you think about money. Example, if you grew up in high inflation, 1970s, you'll hate debt and love cash. If you grew up in low inflation, 2010s, you'll love debt and investments. Neither is crazy. Both shaped by different experiences. The person who grew up poor has different money psychology than someone who grew up rich. Understanding this changes everything about money disagreements. Lesson 2. Luck and risk. Lesson 2. Luck and risk are two sides of the same coin. Bill Gates went to one of the only high schools in the world with a computer in 1968. Luck at his best friend from that school died in a mountaineering accident at 21. Risk. Housel's point: nothing is as good or as bad as it seems. When judging yourself, recognize luck in your success. When judging others, recognize risk in their failure. The rule: focus less on individuals. Focus more on patterns. Don't study one billionaire. Study patterns among hundreds. Lesson 3. Never enough. Lesson 3. Never enough. Rajat Gupta was on the board of Goldman Sachs, earning millions. He committed insider trading for more money, went to prison, lost everything. Bernie Madoff had billions, wanted more. Ponzi scheme. Prison. Though. Hardest financial skill: saying enough. There is no reason to risk what you have and need for what you don't have and don't need. Housel's advice: define your enough. The goalpost doesn't have to keep moving. Social comparison is the enemy of enough. Lesson 4. Compounding. Lesson 4. Compounding. Warren Buffett's net worth is $84+ billion. $84.2 billion came after his 50th birthday. $81.5 billion came after his 65th birthday. His skill is investing. His secret is time. He started at age 10 and never stopped. The lesson: good investing isn't about earning highest returns. It's about earning pretty good returns that you can stick with for the longest time. That's how compounding works. Time is the most powerful force in investing. $1 at 10% for 50 years. $117 at 20% for 10 years. 6. Consistency beats intensity. Lesson 5. Getting vs. keeping wealth. Lesson 5. Getting wealthy versus staying wealthy. Getting money requires taking risks, being optimistic, putting yourself out there. Keeping money requires the opposite: humility, frugality, fear that what you've made can be taken away. Jesse Livermore made $100 million in 1929, billions today. Lost it all. Died broke. Why? He knew how to get wealthy but not how to stay wealthy. Two different skills: getting rich. Offense, risk-taking, optimism. Staying rich, defense, paranoia, survival. Housel's rule: plan on your plan not going according. To plan, always have room for error. Lesson 6. Tails drive everything. Lesson 6. Tails drive everything in venture capital. If you invest in 100 startups, 50 will fail, 30 will return your investment, 10 will do okay. But 1 to 2 will make 100x returns. Those 1-2 wins pay for all the losses and create all the profit. That's a long tail. Same with investing. A few big winners determine almost all your returns. Of Amazon, Apple, Microsoft, these few stocks drove most of the market's gains over decades. Application: it's okay to be wrong a lot, as long as you're massively right sometimes. Tails drive everything. Lesson 7. Freedom. Lesson 7. Freedom is the ultimate goal. The highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today, not fancy cars, big house, expensive watches, but control over your time. Research shows happiness, control over your life, money's greatest value, giving you control over your time. Retiring early isn't about not working. It's about working on what you want, when you want. The test: can you wake up without an alarm? Can you decide how to spend your day? That's wealth. Lesson 8. Man in the car paradox. Lesson 8. The man in the car paradox. You think people will admire you for driving a Ferrari. Reality: people imagine themselves driving the Ferrari. They're not thinking about you. No one is as impressed with your possessions as you are. Respect and admiration come from humility, kindness, intelligence, not material goods. Housel's insight: we buy things to signal status, but people don't give us the status we expect from those things. It's a paradox. The thing you bought to be admired makes you invisible. Lesson 9. Wealth is what you don't see. Lesson 9. Wealth is what you don't see. We see cars, houses, watches, vacations. We don't see the unspent money, the discipline, the restraint. Rich is current income. You can see it. Nice car, big house. Wealth is hidden. It's income not spent. Example: someone driving a 100K car might have 100K income and $0 savings. Someone driving a 30K car might have 100K income and $1 in investments. Wealth is what you don't see. The only way to be wealthy is to not spend money you have. Ironic, but true. Lesson 10. Save money. Lesson 10. Save money. The only factor you can control: your savings rate. Building wealth has little to do with income or investment returns. It's about savings rate. A high income, but spending all of it, no wealth. A moderate income, but saving 50% first, massive wealth. Formula: wealth, yours, income. Ego: the less you care about what others think, the more you save. Housel's advice: don't need a specific reason to save. Save for unknown future, for flexibility, for options. Lesson 11. Reasonable, rational. Lesson 11. Reasonable. Rational finance textbooks say, be rational. Housel says, be reasonable. Example: paying off your mortgage early isn't rational, low interest rate, but if it helps you sleep at night, it's reasonable. The difference. Rational: what spreadsheet says, reasonable. What you can stick with emotionally. The best investment plan is one you'll actually follow, not the one with highest return on paper. Lesson 12. Surprise. Lesson 12. Surprise. The most important economic events are surprises nobody predicted. 9/11, COVID, 2008, crash, dot-com bubble. By definition, the things that move markets most are things nobody saw coming. Lesson: don't rely on specific predictions. Build your plan around survival and flexibility, not forecasts. The future is always surprising. Lesson 13. Room for error. Lesson 13. Room for error. The most important financial decision: having a margin of safety. Plan on your plan not going according to plan. Examples: don't invest money you'll need in 2 years, even if returns look good. Have 3 6-months emergency fund. Don't use 100% leverage even if calculations show it's safe. Housel's rule: use 1/3 less leverage than you think you can handle. Need only 10% return. Aim for 15% to have cushion. Room for error. Survival or compounding. Wealth. Key lessons summary. Quick summary of main lessons. No one's crazy. Different experiences create different money behaviors. Luck and risk both exist. Acknowledge both. Never enough. Know when to say enough. Compounding. Time is your greatest advantage. Getting versus keeping. Different skills needed. Tails drive everything. Few big winners matter most. Freedom. Control over time is real wealth. Man in car paradox. Possessions don't earn admiration. Wealth is invisible. It's what you don't spend. 10. Save money. Highest controllable factor is 7. Reasonable. Rational, sustainable beats optimal 12. Surprise, future is unpredictable 13. Room for error, margin of safety is crucial. Housel's core message: money isn't about spreadsheets and math. It's about behavior, emotions, and psychology. Financial success is a soft skill where how you behave matters more than what you know. Your action steps: what to do after watching. Define your enough. What's the amount that would make you truly content? Write it down. Stop moving the goalpost. Calculate. Your savings rate, not your income. Your percentage saved. Try to increase it 1% this month. Build room for error emergency fund. 3 to 6 months expenses. Don't invest money you'll need in next 2 to 3 years. Focus on time, not timing. Stop trying to time market. Start investing consistently, for decades. Value freedom over stuff before buying something. Ask, will this give me more freedom or less? 6. Be reasonable, not rational. Choose strategies you can stick with emotionally. Best plan: one you'll actually follow. Final thought. The big takeaway. Ronald Reed, the janitor with $8 million, understood behavior. He lived below his means, invested consistently, gave time to compound, never tried to get rich quick. Richard Foscone, the Harvard MBA, understood finance, but not behavior. Technical knowledge doesn't matter if behavior is wrong. Money success formula: behavior plus time plus room for error. Wealth, that's the psychology of money outro. If this helped, like and subscribe. Comment, what's your biggest money lesson? Thanks for watching, and